So what I want to do here is I want to kind of turn it over to Mark. I do have his bio in the handouts, but I'll just kind of give you just a quick background of him. He's been gracious enough to kind of help us out tonight, and he's the director in the Advisor Insights team focused on investment strategies and education. He's a 25-year industry veteran with extensive expertise and experience educating financial professionals and investors on markets and investment topics. And his responsibilities include relating BlackRock's investment strategies and investment views to financial professionals and clients. And he's the author of the popular Student of the Market monthly publication that's distributed widely to financial professionals across the country. So again, we've got a seasoned veteran right here. When we looked at the beginning of the year, we actually, everybody was very bearish. Everybody felt that we're going to have a bear market recession. Things were kind of hanging in there, but all the indicators kind of showed us that things were kind of going to turn down. 2022, really rough year for both stocks and bonds. But what you talked about specifically last year was, hey, listen, this is a cycle. We see things going to come back, and that's exactly what happened. And so, anyway, I'm just going to kind of turn it over to you and see what your kind of talk about your July kind of overview.
Sure. Thanks, Jim. Good evening, everybody. Thanks for having me on your call to talk a little bit about the markets and the economy. As Jim mentioned, a little bit of surprise this year. Certainly a mixed bag economically. I think you're seeing a slowing economy, but still more strength than I think a lot of folks were expecting, as Jim alluded to. And I think that really the big story has been the Federal Reserve has raised short-term interest rates to try and really rein in inflation. So it's been, I think about it as a race between what's going to happen first, slowing inflation or the economy going into a recession. That's really been what the market's trying to keep an eye on, because the Federal Reserve raising short-term interest rates clearly is slowing the economy. You're starting to see that really start to take hold, but it does take a while. So think about that race. I think that's why the stock market's been a little better than expected, because inflation has come down from about 9% to about 3% today. So that's significant from last year. And you haven't really seen the economy roll over, even though it's weakening materially. So I think that's a good way to think about it, just that race between inflation coming down and damage to the economy. As far as July student of the market, you'll know right away, you'll notice right away, and Jim knows this well, that I'm a chart and graph guy, so I didn't leave many in the bag, but just wanted to hit a couple of highlights here that I thought was interesting. If we could skip ahead, Jim, first off, just talk about this year. What a good start this year is to the year for stocks. If you just click, I think, ahead to the next slide. Thank you.
Sure.
You can see that going back almost 100 years, about 98 years where we have good data. It's the 14th best start of the year for stocks. Just go back to the next one, actually, the previous one.
We there now?
Nope. Go back one. Thank you. There we go. And you can see up about just under 17% year to date. And you can see these are the 20th best starts to a calendar year in history. And you can see some recent years here. You can see certainly 2019 wasn't too different. Even 2021 is on here towards the bottom there, number 19. Up about 15.3%. So some recent years have been pretty darn similar. And you can see what happened in the back half of the year. They were both up double digits in the second half of the year as well. So they maintained that momentum. And this is something we looked at. Generally, if you have a positive first half of the year, you can see this on the right. If the first 6 months are positive, you're much more likely to have a better second half of the year. You can see that your average return over 7% versus only 3.6 if you had a negative first 6 months of the year. So that's a good sign. Just generally what we see historically with stocks. If they have momentum, it generally carries forward in the second half of the year. We're off to a good start so far in July. Market was up again today, so certainly starting to carry through some of that momentum. If we skip ahead to the next slide, one of the stories, I think there are really two big stories underneath the stock market return, is the fact that we've had no volatility. And what we mean by volatility is just how much stocks move up or down in a given day, week or month, or even a quarter. And this looks at days. So just how many days the market's up 2% or more or down 2% or worse. And you can see last year we had 46 of those days last year. And this year we've only had 2. Even with all the concerns we've had around bank failures, recession, higher interest rates, higher inflation, etc., we've only had 2 plus or minus 2% days, which is very different than what we experienced last year. And you can see on the right side of the slide, we just highlighted the fact that, hey, when you get not much volatility, when the market's not jumping around day to day, it tends to be a pretty positive sign for the market. You can see if we had in years in which we had 10 or less 2% trading days, you average over 17% for the year. Whereas if you have more than 10, like we did last year, your returns are going to be a lot more challenged in that environment. You average just about 0, slightly above 0. But I think it tells a good story with stocks over the years. You can see some of these calendar years, like back in 2008, you can see 72 days where the market was up or down by 2% or more, right? That's 1 every 3 or 4 days because the stock market's open about 250 days a year. So 1 every 3 or 4 days, you were getting a 2% move in the stock market back in 2008. That's certainly significant. Last year, 46. 2020 was 44 when we had the pandemic setting in. So you can see whenever there's a lot of uncertainty, a lot of concern about the economy, that's when you tend to see a lot of 2% days, a lot of volatility in the stock market. That just hasn't been the case this year. I think the market's feeling better about where we're headed, even with those higher interest rates trying to rein in inflation. So I think that's been an important story. Now, underneath this, we don't have a slide for this month, but we've shown it in the past, is the fact that the returns for the stock market have been pretty concentrated in the largest stocks. Some of those largest technology names at the top of the index, Apple, Microsoft, NVIDIA, go down the list, Google, certainly Amazon, Tesla, those kind of names have really driven a lot of the returns. So it's been pretty concentrated at the top. And some of that is excitement around artificial intelligence, AI, and the impact that it'll have on the economy. You're starting to see that get priced into some of those technology names that can take advantage of it. So Microsoft was up big today on thoughts that they could take advantage of artificial intelligence and make the economy more efficient going forward. So certainly that's been a big driver for some of those largest names within the U.S. stock market so far this year. So I think really that combination story, very little volatility and really nice gains in the technology space. Some of those largest tech names driving a lot of those returns. Stepping ahead to the next slide, we can just look at something that we touched on, which is the Federal Reserve raising short-term interest rates. And they've raised short-term interest rates from about 0 to over 5% now. They've got a meeting next week, which they might raise interest rates another 0.25% next week. So it could be up to 5.5% that they've raised short-term interest rates in a little bit over a year, about a year and a quarter now, when they started raising interest rates last year. Again, trying to rein in inflation, bring inflation down is really what they're trying to do. And we just looked at the reality that when you get a lot of increases in short-term interest rates, that's an environment where stocks and bonds can really struggle. So whenever they raise interest rates more than 1% in a given year, you can see the returns on the left in the red across the board just aren't as good on average. Whereas if they raise interest rates less than 1%, that's more of a sweet spot. So this month, I think it puts us right on the border, right? If they raise interest rates one more time this year, that's right around 1% for the year. And if they stop there, I think we could look more like the right side of the page, where you see better returns in a calendar year in which the Fed doesn't raise interest rates as much as they did last year. So just something to keep an eye on. It's probably pretty intuitive for most of us. Just the fact that, hey, higher interest rates last year were the big driver of that bad performance for both stocks and bonds. If you get less of that this year, that's probably good news for both stocks and bonds. And I think we've seen that so far this year.
Mm-hmm.
next slide, Jim. I think one thing that I think has surprised people and certainly surprised us is we've seen a lot of cash on the sidelines. So a lot of dollars coming out of bank accounts, going into money markets and CDs. So I just wanted to pull out the historical table on what inflation looks like, what cash and bonds and stocks looks like over various decades, what it's done so far here in the 2020s here. Because if you look at the bottom of the chart, pretty unusual. We've got a lot of cash on the sidelines, and it's really reflecting the fact that we had a really tough year last year in markets, both stocks and bonds, worst year ever for bonds last year. And now we've got interest rates on cash and CDs, traditional bank CDs, paying 4 or 5%, the highest levels we've probably seen prior to the global financial crisis back in 2008, so 15 years. So it's been really attractive for a lot of folks to just say, hey, I can move it out of the bank. I can put it to work in money market CDs, very safe savings vehicles, which for short-term funding is a great idea. Certainly take advantage of those higher interest rates. But we're seeing a lot of other dollars there that are probably investment longer-term dollars that probably shouldn't be there. And it's understandable why, again, because last year, tough year, never feels good to lose money in stocks and bonds like we did last year. And then cash rates are often higher than some of those bond and fixed income interest rates that you're getting right now. But look at the bottom of the chart, kind of the bottom middle. You can see historically cash never outproduces bonds over the longer term. Certainly doesn't do so for stocks except for a handful of periods. But you can see on the bond side, this is an unusual period where we've had a rough stretch for bonds and cash has actually outperformed. We actually think it's a great time to put money to work back into bonds at this point. You're getting much better interest rates than we were a couple of years ago. It might not be as much as cash, but then we think there could be an opportunity for better total return in bonds going forward. This chart will normalize at some point here in the 2020s where your bonds are going to start returning more than cash. We just think it's a little bit of a cash trap, if you will. It seems like the easiest, obvious choice. That's never the best choice when it comes to investing. So moving ahead, the next slide, I think really captures some of those things that we're looking forward to on the bond side and why we think it's a good time to put money to work into bonds and fixed income versus cash. Really three things here. First off, we mentioned short-term interest rates are higher than long-term rates, which might seem completely counterintuitive, right? Why would you ever want to take less income, but lock up your money for a longer period of time in a longer term bond or fixed income vehicle? But history actually tells you do better than cash in this type of environment. So again, kind of illustrating that cash trap, if you will. History tells us it's better really anywhere in the bond and fixed income world for those investment dollars, those longer term dollars that you have. And also, if the Federal Reserve stops, number two, in the middle there, if the Federal Reserve stops raising short-term interest rates, like this might be the last time they do that here in July, look at the returns for bonds versus cash whenever the Federal Reserve is done raising short-term interest rates. Again, bonds significantly outperform cash coming out of that environment. And third and finally, and I think this is maybe the most important one, is number three, is whenever inflation is actually below that rate on federal funds. So again, they've taken federal funds interest rate from 0 to 5, might be 5.5 here coming up here at the end of July. Inflation's down to 3%. So whenever that federal funds rate at 5.5 is greater than inflation at 3, look at the performance for fixed income funds, 7.5%. When we see that environment. So for us, this is just checking all the boxes for core bonds and fixed income versus cash. We just think it makes a ton of sense in this environment. Again, I think it's good for short-term savings, but longer-term investment dollars, great time to put money to work in fixed income. Certainly, Jim can help you sift through those options. Certainly in his wheelhouse to do that. But for us, we think it's a perfect environment to explore that.
Yeah, I would agree with you, Mark. I mean, it's again, I've been listening to the BlackRock calls and many other sources, and I just, again, you want to kind of get into the bonds, now, and this is why you want to stay fully invested. And so I think one of the big dangers that people have is staying in cash too long, and they're missing out on opportunities. I've seen that with a number of clients recently. So you've had a very good point there.
Yeah, no, absolutely. And just shifting gears a little bit to the stock side of things, just wanted to highlight something we've touched on a little bit in student market over the last handful of years. And it really builds on how we talked about how concentrated the return for the U.S. stock market has been in technology and some of those big names that we mentioned earlier. But it's also kind of that growth style. So some of the companies that are growing fastest in the overall stock market, and you're pretty heavy overweight to growth exposure within that large cap index, which is unusual. Normally, you don't see this type of more imbalance in the index. Normally, it's very equal to value and growth. So some of those names in the index that are just cheap and undervalued, and some of those names that are just great growers, great at producing returns. Normally, it's much more in balance, but we're really heavy towards growth, which is a little bit of concern, just because it does create some downside risk at some point. Just something to keep an eye on and put on the radar. That growth's been the great story, certainly this year over the longer term. Last year, not so much, but if you look longer term, growth has really been the driver of the U.S. stock market over the last decade. Just be careful, and Jim certainly can help you reduce some of that risk. We just want to flag it for you because it doesn't last forever. At a certain point, some of those growth stocks just aren't going to go to the moon from a return standpoint. They're going to take a breather. They're going to take a rest. Just want to make sure your portfolio doesn't have too much risk within those growth style names within that core, core
Mark,
US exposure.
That's exactly what happened with technology last year. Remember that technology as a sector had just been killing it for many, many years, and then it was down roughly 33-34% last year. So yeah, I mean, we see the growth in some of these high-flying sectors that have just been dominant, but eventually they will fall like they did last year. But you can see right now, technology is one of the top performing asset class in 2023. So yeah, I mean, and this is I just kind of Mark is doing a great job kind of showing us, but this is also he's kind of proven the point why institutional money management really makes sense, because you really need to understand what's going on underneath the surface and where these opportunities are. And so just putting money into an index fund is not the best way to manage money. And I think you're sort of making your point here, Mark, where there's a lot of stuff with bonds and all these different cycles that are going on that really require hands-on, management. So anyway, I'll go on to the next slide right here.
Yeah, it's a great. I think you hit it, Jim, last year, right? You had a lot of downside risk in some of those growth names, and you saw it in performance, and that was a struggle. And I think I think about it as kind of the iceberg in the blizzard, right? We get caught up in the blizzard a lot of times, but really the overweight to growth within those large index funds is kind of that iceberg under the surface that you can't see. So that's why we pulled attention to it. And this chart just really builds on it and just shows you that you'd actually have to buy about a third, 35% roughly of the value index, and add that to the S&P 500 just to get back to style neutral. Not that that's the only way to reduce risk, but that's just how dramatic it is, that overweight to growth right now. It's just not something you see historically within those index funds. You just don't see it this overweight to growth. So again, Jim can help you navigate this. You can see on the bottom, we just highlighted worried about downside risk in your portfolio. It's more than just adding value. It could be other high quality stocks or dividend payers, dividend growers, just some of those other defensive stock strategies that we think will help balance an overall portfolio and help you avoid that iceberg under the surface that is that overweight towards the growth names within the large cap stock world.
Well, just kind of piggybacking off of that, Mark, where the allocation, by the way, the new models are most likely going to come out this week. Again, Mark, if you know, my core model is the target allocation ETF model and the tax aware models. And if you just look at those positions at this point, what Mark was just talking about was basically being able to ramp up and ramp down risk when the market's kind of telling you so. So if you look at the the portfolio right now, you'll notice one of the ETFs called high quality stocks. You'll also see minimal volatility. So it's a way that we can actually still remain fully invested, but also back off some of the risk. There's still risk out there. The market's up, but again, the indicators from many different sources are still kind of showing a very kind of bearish outlook. So, but it's sometimes the indicators are there, but the markets are doing a different thing. So that's why that diversified portfolio, when you're able to kind of ramp up or ramp down some of the risks, are super important. And that's kind of what's happening, proactively in the portfolio right now. And again, this is the downside risk. I've talked about this a bunch, Mark, but I'll let you kind of take over on this. This is why we try to minimize, drawdowns in portfolios.
Yeah, exactly. This is, I feel like this is an anthem for us and you, Jim. Just the importance of that downside risk mitigation, right? Just the math behind it. And I'm sure nobody was expecting a math quiz when they joined the call today, but I do think it's important to understand the math of the downside, especially when you're in retirement income mode. It always amazes me when I look at these numbers. If you were just accumulating, if you lose 10%, you'd only have to be up 11% to get back to break even, right? So down 10, you'd have to be up 11% to get back to break even. But it changes as the loss gets bigger. Look at minus 40. Now all of a sudden you got to be up 67% just to break even. In fact, if we had a minus 50, you have to be up 100% at minus 50 just to get back to break even. But what we added is as an additional dimension here that shows if you're taking a 4% withdrawal over a 5-year stretch and have a 10% loss, look what happens. Now all of a sudden you have to be up 43% just to get back to break even in that scenario. So even a slight loss in that retirement income, when you start taking income off of your portfolio, that downside risk mitigation becomes even more important. It's always important, but it really becomes critical in that retirement income mode. And I just think the industry doesn't do a great job telling this story. I think folks don't realize how big of a difference it can be when you're starting taking income off your portfolio, and what that downside risk can mean to your overall outcome. Just the results can vary widely. So for us, just a good reminder, again, this is something that Jim can help you with, but downside risk is always important. When you're in that retirement income mode and start taking income off your portfolio, it's even more important to get that downside risk dialed in. Because look at minus 40% loss. With that 4% withdrawal, all of a sudden now you've got to be up 150% to get back to break even. At that point, most portfolios would be impaired, right? You just wouldn't be able to take the level of income you might need because that level of loss is too great. So I think all these things tie a little bit together where we see a lot of risk across the industry. Make sure you have some of that balance checked in. Certainly you're going to have that in your the model Jim touched on, but just something to flag as well. Just if you're taking income off that, it's even more important to focus in on that downside. So again, very similar themes across the board here, but hopefully helpful. I think, again, think about where we started. It's been a better start to the year. Stocks, 14th best start in history. That's a good sign, good momentum. It's been very little volatility in the stock market, which is a good sign historically for a good year in returns, but it's been pretty concentrated in a lot of those growth names. So that's certainly something to keep an eye on. You want to make sure you don't run into that iceberg of too much growth risk within your portfolio at a certain point. And of course, we think it's a great time to put money to work into bonds and fixed income. I think we're just at that point in the cycle. We saw those 3 different check boxes, right? Federal funds rate is above inflation finally. The Fed might be done here next week raising short-term interest rates. And that cash trap where short-term interest rates are higher than long-term rates, it looks like an easy choice, but actually history tells you it's better to take advantage of bonds and fixed income at that point. So I think all those things point you towards some fixed income solutions that Jim can help you with.
Absolutely. So I think that's the last. Yeah, that's the last slide right there. So if you guys have any questions, you can put those questions in the chat and we will kind of answer them. And I'll just kind of give you a minute or so to do that. But just kind of, you can put your questions in the chat or the Q&A. I don't see any questions in there at the moment, but feel free to kind of put those in. And
one thing I'll mention, Jim, just on inflation, I think inflation is going to be interesting here. It is down to 3%. It was 9% last June, if folks can believe that. It's come down to 3%, but it's going to bounce around now between now and year end. It's going to bounce between 3 and 4% for the rest of the year. So it might give the illusion that it's kind of stopped going down, but it's just really the way the numbers are going to roll. By the beginning of next year, it'll start coming down more, just because of the way how the numbers roll within the inflation calculation. Jim knows I'm an inflation geek, so I'm gonna hit at all the cocktail parties again. It's a little bit of my inflation soapbox, but just understand the dynamic that it's going to look a little bit choppy here with inflation over the next handful of months. What's going to happen is the headline inflation number that's at 3 is probably going to tick up a little bit, but that core inflation, which is outside of food and energy, some of the volatile pieces, that's still at about 4.8%. That number is going to come down closer to 4%. So you're going to just kind of have those two numbers start to get more in sync, like they normally are over the next course of 6 months. But just keep an eye on that, because it's going to give some mixed signals, like a lot of things in the economy right now. I think we hit it at the beginning, but very much a mixed bag economically right now. You're seeing a good job market, but you're clearly seeing some slowing in the manufacturing, some of the bank lending, some of those type of areas are clearly slowing. And those tend to be better leading indicators of an economy, where jobs tend to be the last thing that kind of falls off the ledge. So it's clearly a slowing economy, but better than we thought at the beginning of the year. So again, that race between inflation and the economy, inflation's winning right now, which has been good news for stocks and bonds.
Mm-hmm. So that's great. Mark, thanks so much for that recap. Now, obviously, if you guys want to follow up with a call, or I also put the link to my calendar in the chat, and it's also, you can go to my website about that as well. If there's any questions, go ahead and put them in the chat. But that's going to conclude the actual Q3 market update.